Chase for profits. As I mentioned, we all know, or many of us know, that the markets are near or at all-time highs, whether it's the NASDAQ, whether it's the Toronto Stock Exchange, even the Dow is in that area, Russell 2000, which are your small cap stocks in the US. Markets right now are at all-time highs. And it's interesting because you're getting a lot of, or at least I've been getting a lot of questions from investors asking me, Alan, what about this Broadcom stock or Nvidia? Should I be buying it today? Stock's gone up by quite a bit. Is it going to continue to rise? Should I be putting more money into it? And I've been getting a lot of questions from individuals that normally wouldn't be asking these types of questions. Normally, they'd be content holding, I would say, less volatile names, stocks, or less volatile or lower risk investment ideas in general. But there has been this thirst for stocks recently. The chase for profits has led many investors to buy stocks that perhaps normally you would not see these investors in the stock market. Our first chart clearly shows this. It is the graph, and tough to see what it says along the top, but what it does say is it's a graph which shows 45% Americans direct or indirect stock ownership so as of September 11, 2025. And so you can see here very simply that over the last, well, let's call it 20 years or longer, people have been piling into stocks. It's been that chase for profits. It's been the opportunity. If you're not in the market, you're at an opportunity. You're costing yourself significant growth. With interest rates as low as they are, I've used the acronym on the show before, TINA. There is no alternative to the stock market for growth, especially when interest rates are as low as they have been at times, as low as they are now, and possibly going lower as the Bank of Canada just cut interest rates by a quarter point. The Federal Reserve is cutting interest rates recently by a quarter point, and both banks look to cut interest rates even further at our next meeting. So with that in mind, yes, more people are piling in to the stock market. Our next chart here is of a stock that I've talked about many times on our show, and that is Broadcom. They are a diversified company, not all eggs in the AI basket. They make custom chips, as many of us know. It's a bigger and bigger market for them. They also own other parts of the business, software as well. VMware is a company, a massive company that they've just purchased over the last few years, which broaden their business, getting them involved in many different areas of the market. But if you piled into the name most recently, well, you can see how well the stock has done. But if you look at the kind of the top right-hand side of this chart, you can see that Broadcom stock has started to fall off. This stock was about 17% higher at one point and just in the last few months. And so if you were chasing profits, if you were chasing the hot stock, and if you were chasing a name like Broadcom, you possibly would be disappointed if you bought shares recently. Now, of course, if you own shares for a little while already, perhaps it would be a good idea to trim some of the profits there. And as some of my investors would probably tell you, that's what we've been doing, taking some profits off the top, still owning the name because I think it can go higher. But the prudent thing to do would be to take some profit. Another name, and this is an interesting name, called Oracle. And the name Oracle, many of you might recognize, but I think most people don't recognize. They're a data center AI, data center infrastructure investment software, a massive name. Larry Ellison, once CEO of the company. Now I think he's the chairman. At one point, when Oracle, as you can see here on the chart, it went up, I think, 35, 36% in one day due to what they said during their earnings call, that potential business down the road would be massive from the hyperscalers, from the names, the biggest names in the world, the Googles and the Metas, et cetera. Their business would continue. Their backlog, they announced, was quite substantial. Stock went up 36%. What happened shortly after? Had you piled into this name, chasing the profits, the hot stock? Well, you can see Oracle has come down significantly. It's come down by, I would say at one point it reached a high of close to $340 a share. So you can see it's down about $60, almost 20% from the high, and it's given back a lot of its gains. So once again, this chase for profits in most cases just doesn't work. If you see a stock going up and valuations are starting to get stretched because of that, then it's a name that you probably don't want to pile into, and perhaps you take a bit of a pass if you don't own it already. The next chart that I have here called Emera. Now, for those of you that don't know Emera Inc., they are just a plain Jane utilities company out in Eastern Canada. However, if you own this stock, it pays a 4 or 5% dividend. Right now, somewhere around, in between 4 and 5%. But if you own the stock over the last 6-7 months, you would have had roughly a 15-20% return on the shares, capital gains that is, and you'd be getting this 4.5% dividend as it sits right now. So I wanted to compare this chase for profit versus owning a good quality utility, something that many would say, oh, it's just boring. And you could still, and this example clearly shows that you could still make money from good quality, as many would call boring names. And, the other day I was talking to an investor and I said, I have this idea. I think it's good to make, 20, 30%. I think the shares are undervalued and that's what you can make. And they turned around and said, Allan, 20, 30%, that's nothing. These days, people are making 50% in Nvidia or Oracle or Broadcom or whatever tech stock they may have heard. I couldn't believe it. Since when does a 20 to 30% return not become enough? Well, it's not enough if people are tracing these hot stocks, and they've been hot for quite some time. They're your big cap tech names. A lot of them are a part of the Mag 7, or it's an AMD, or whatever it is. They're artificial intelligence in that area or that space, and they've made investors a lot of money. So I guess my main message is this today. Don't chase that hot stock. You never know when you could have an Oracle on your hands or even a Broadcom whereby it has a quick pullback. Wait for a dip before you buy some of these names, especially if they've really gone significantly higher. I'm not saying not to own them at some point, but for example, I've been looking at Microsoft. I looked at Microsoft for years before I had an opportunity to buy on a dip back in 2022, and I've been a buyer ever since. So you want to do your homework. You want to look at good quality investments, but you want to buy them at reasonable prices. And I think if you do that and not chase the hot stock or have that chase for just profits, I think that is the best way to grow your portfolio over time and the best recipe for success.